Hey, good morning, everyone. Welcome back to another episode here at the Denver Investment Real Estate Podcast. So, this is our episode 3 in our 3-part series on tax planning with Peter McFarland. So, if you've not caught the first 2 episodes, I'd recommend you listen to those first because the first one's introductory, second one's intermediate. Now, the third one's more advanced. So they do build on top of each other. So check the show notes or go to denverinvestmentrealestate.com/taxes, TAXES, and I'll forward you to the recording of these 3 episodes plus any future ones that we do in the future. So today, back in the studio, I've got Peter McFarland. Peter, good to have you back.
Yeah, thanks, Chris.
And Peter is both a CPA and a lawyer, so he's a wonderful person to talk to us about these real estate taxes. He's been in the industry, and I should say the real estate investing community for quite a few years now. So he knows this. He's done a lot of work with the people around town, a lot of our listeners out there. So he is my go-to expert when I've got legal questions and tax questions here in Denver on real estate. So this is the 3rd episode, and we're actually going to be talking about exit strategies. So Peter, what's the bullet points of what we're talking about today?
Yeah, good question. And yeah, I have to actually look because I'm actually excited about this presentation because this is actually mostly new content, stuff that I have not actually put into a presentation before, mainly because a lot of investors are maybe stuck into a long strategy and just, the amount of time hasn't necessarily come around where they're really beginning to look at exits. And so it's really good to talk about, and we occasionally do in meetings at the office, but to present it on a large scale and actually have a presentation on it, it's just never really been like a hot topic. So I'm actually kind of excited. But today, what I'm talking about is really the tax treatment of exiting investments. Particularly what I want to talk about a little bit is capital gains versus ordinary income. It's funny because this is now the 3rd kind of specific class on tax that we've done, and I haven't even really dug into say like, okay, what actually is capital gain or ordinary income? So it's going to be good to kind of flesh that out. Then we're going to talk about specific strategies kind of related to each of your different potential investing strategies. So maybe identify, okay, what kind of investor are you, and then what's your most likely exit? What's the tax treatment of that exit? And then specifically, we're going to talk about some programs available under the tax laws, mainly 1031 exchanges or like-kind exchanges. We're going to talk about opportunity zones, which is a brand new thing in the Tax Cuts and Jobs Act. So that's really exciting to talk about. And then, time allowing, and I won't do a real deep dive on this, but what we're going to do is talk a little bit about some estate planning opportunities, things that you might keep in mind, and kind of bigger picture things to maybe transfer some wealth to your descendants. So we got a lot to talk about today.
Good, and I'll try to keep my questions to a minimum so we don't have a marathon one again. But I'll probably ask you a bunch of questions. This is fun stuff.
Yeah, no, Chris, I actually really appreciate your questions because I would say that your questions are maybe it's a deeper dive, and so it actually gets my gray cells moving a little bit. And I think it may bring up some issues that we otherwise wouldn't get to, if we were just kind of staying on the surface rather than doing that deep dive. So I certainly welcome those.
Well, thank you for the license to ask questions. I will now.
Excellent. Yeah, well, just a little bit more about me. I mean, I'm an attorney. I'm a partner at Long Law Group, and we have 2 companies, really. They're sister companies. We have the law firm, Long Law Group, and then we have this other company, Business Innovation Group. Business Innovation Group, I'm a senior business advisor there, which is kind of the most senior title that we have in that company. But at any rate, with Business Innovation Group in particular, really we draw on the team and the strength of the team. And so I just wanted to give you a sense of kind of who all is involved with this company. It's certainly more than me, and I do draw on expertise outside of even where my wheelhouse is. But really what we're looking at doing, and this is kind of both in the law firm and Business Innovation Group as well, is we're doing business advisory and planning. We're looking at doing revenue and profit improvement, cash flow analysis. We can do a really cool thing where we actually use your company's numbers in your bookkeeping, and we can actually forecast out into the future, run several what-if scenarios, see what's going on with your company, how healthy it is, how well it can adapt to certain market changes. So the forecasting, I think, is one of the most valuable things that we do, and we're really proud to offer that service. But we do tax planning and preparation as well, bookkeeping. We set up business entities and advise kind of on their entire life cycle. executive development, and of course, real estate strategy and planning, because we have been around in the real estate realm for quite a while now. So quite a bit that we do there. But, if you've been on the other webinars here, you know that I like to kind of give a little bit of an opening perspective. This one actually mirrors what I talked about in 201, because really I think that the overarching theme here is really the same, which is that if you look at trends and data and look at what happens to our relative tax burdens over the years, and the Tax Cuts and Jobs Act in the short run may have actually kind of limited this, but in the long run, the projections show that actually it is the case that we over time are actually going to pay more tax. Our tax burdens are going to increase. So what we're looking to do, and really what my job is and what I make a living doing, is tax avoidance, not tax evasion. And Chris, I've asked you this before, but do you know the difference between tax evasion and tax avoidance?
I do now.
Yes.
10 to 20 years in jail.
That's right. It's a really cheesy joke, and I can't help but tell it, but that's, I'm going to do that. But at any rate, tax evasion, of course, is what they got Al Capone on. And tax avoidance, on the other hand, is what you do if you're well-versed in what the tax laws are, the legal ways to avoid paying more tax than you really do. And what I really want to do, and what kind of gets me out of bed in the morning, and when I view myself as doing a really good job for my clients, is that I'm looking at doing, everybody's looking to do their patriotic duty here, right? We're going to pay our tax, but we're not going to pay any more than we're legally obligated to pay, right? Not one penny more. And if you pay anything more than you're legally obligated to pay, it's really just a gift to the IRS, right? And I've said this before again on 201, but the idea is, if you pay extra tax to the IRS is never going to come back to your house in 3-4 years and say, if you had become an S corporation, or if you had taken this one particular election or something, you would have paid $5,000 less in tax. So here's your $5,000 back. I mean, they're never going to do that. So it really, truly is a gift to the IRS when you pay more than you really need to. So that's what we're trying to do today. We're looking at ways to exit your investments, or exit your investment strategy, and not pay any more tax than you really need to. So with that, I'm actually going to jump right in, and let's talk about capital gain versus ordinary income. And the reason this is important is because a lot of what I'm going to talk about today is going to revolve around whether we're going to be paying capital gains tax or whether we're going to be taxed at ordinary income rates. So this kind of sets the whole groundwork or basis for what we're going to be talking about. So the first is, what is capital gain, right? Well, I hate just citing to the code because, number one, it's not terribly helpful the way that it's written, but also I think it's also terribly boring for everybody on the call. So my apologies. But if you do want to know what the tax code says, it says that capital gain is gain from the sale or exchange of a capital asset. Well, that's not terribly helpful, right? Because we don't really know what a capital asset is, or, so if you go further and actually look at what a capital asset is, what it means is property held by the taxpayer, but it doesn't include certain things. And so what's kind of interesting about the definition of capital gain here is that it's actually incredibly broad. It starts almost at the most broad, in the most broad way that it possibly can. And it just says, look, it's property held by the taxpayer, except for these specific things that it's not, right? And so that's inventory, depreciable business property, or real estate. So anything that you're depreciating is not going to be a capital asset. Copyrights, accounts or notes receivable, there's some government obligations, government publications, certain IPs, and other kind of miscellaneous things here. But the main thing to keep in mind, I think the biggest category that I'm going to be talking about today really is inventory, right? If you have inventory, that is not going to be a capital asset. So if you're selling what kind of constitutes your inventory, really we're talking about ordinary income. Ordinary income for inventory. But anything else, I'm going to be looking at capital asset, right?
So a couple questions here. Short-term government obligations, is that government debt like bonds?
Exactly. Yeah.
So that's actually, so if I buy them, so short-term, I guess less than a year?
Correct. Yeah, exactly. And there's also limitations in there about what kind of interest it pays. But basically, each of these little categories here, actually, there's like maybe an entire sentence that describes what they actually are.
Okay.
I'm just shortening this down to make it a little more manageable for us. But yeah, as a general rule, if it's less than a year and it is one of those government obligations, like even a municipal bond or any kind of state or local bond, yeah, absolutely, less than a year, you're not looking at a capital asset with that.
Interesting. I didn't know that.
Yeah.
Not that if I sell a bond making my 1.2%, I don't think it's going to make a big difference at the end of the year, but I learned something.
Right. Yeah. We're probably not talking about a huge amount of gain when you sell those, but either way, yeah. So, I mean, to go back here, so what is capital gain? I mean, gain is capital gain is gain from the sale or exchange of a capital asset. And really what I'm saying here is that it's basically going to be anything that you're holding except for inventory, right? There are other carve outs there, but for purposes today, really inventory is our big one.
Now, when you say depreciable business property / real estate,
mm-hmm.
Do you mean like if I buy an investment property, or what does this line mean right here? Or this bullet point?
Yeah, that's it's actually a good question. No, so if you're depreciating, say, one rental property over 27 and a half years, that's still a capital asset. I think what they're talking about there is it's easier in a way to focus more on the business property, because if you're actually looking at, say, equipment like a truck or some type of like machine, like a lathe or something like that, you're depreciating that over a certain amount of time. And that's going to fall outside the definition of a capital asset. So it's kind of hard to envision real estate that's going to go hand in hand with that type of asset, but that's kind of what they're driving at there. But the sale of like one single rental property depreciated over 27 and a half years, that's still going to be a capital asset, because potentially that's going to give you capital gain depending on your frequency, but we'll get more into that. Yeah, with that particular bullet point, it may actually be helpful to have the whole sentence, because that is kind of an important distinction. But at the moment, I wouldn't focus too much on that.
Perfect. You answered my question. I just wanted the clarification.
Yeah. That's in some ways it's good to do this. Like I was saying, this is brand new content for me, brand new webinar. And so that bullet point there, I actually would in subsequent presentations actually pull that out a little bit more. But either way, if you guys have questions on that, you can always reach out to me, after the recording or whatever. And I'm happy to talk more about what that means and how it might apply to you. So at any rate, you may have heard of long-term capital gain versus short-term capital gain. And it's pretty much just what it sounds like. I mean, you're holding long-term, or to get long-term capital gain, you just have to hold the capital asset for longer. So to qualify for long-term capital gain, you just have to hold the asset for 1 year or longer. And short-term capital gain just means that you've held it for less than 1 year, right? So pretty straightforward there. So if we know what capital gain is now, let's talk about ordinary income. The reason that I brought this up second is because, once again, this is how helpful the code section is. The code section just says, look, ordinary income is gain from the sale or exchange of property, which is not a capital asset. So it's like to understand what ordinary income is, you have to understand what a capital asset is. And then if it's not a capital asset, well, then you're looking at ordinary income, right? So if you look back at the definition of capital asset, it's property held by the taxpayer, but it doesn't include, say, inventory, right? And so just on the bottom there, kind of highlighted in yellow there, I'm showing kind of the most common types of ordinary income, and really probably what we're going to talk about today, which is inventory, W-2 income, 1099 income. And then what's a little weird is I put short-term capital gain there. Well, short-term capital gain technically is not ordinary income, but it's taxed at the ordinary income rates. So if I'm going to talk about short-term capital gain, it's almost interchangeable with ordinary income, because we're going to pay the same tax on it.
So going forward, even though they're different, we can just assume if we're talking about, or if we're having to pay a short-term capital gain, those be at our normal tax bracket, ordinary income.
Exactly. Okay. Yeah. In a way, like you're just increasing the amount of your W-2 income. Yeah. So that's a little bit weird, but that's, that's what I wanted to talk about. But I mean, why does it matter, right? Why do we even care if it's capital gain or if it's ordinary income? And the reason is, and you may have heard this, is that capital gain is taxed at what they call a preferential rate. Right. And so the table that I have on the left there, kind of down below and on the left, that's the capital gain tax brackets right there. And then on the upper right there, that's the ordinary income brackets. And so you can see, first off, for capital gain, there's only 3 brackets, and the top bracket is 20%. Over on the right, there's 7 brackets, and the top bracket is 37%, right? And so if you're looking very closely at it, actually, let me see. For married individuals filing joint returns, the 15% bracket on capital gains, basically what it means is if you're earning $78,750 or less, any capital gains that you have are going to be taxed at 15%, right? If you go over to the other table, if you were earning $78,750, and if your capital gain were actually taxed at the ordinary rate, you would be paying 22%. So it's about a 7% tax break just to call it capital gain versus ordinary income.
So I need to ask a question here, because this says, as I've gone to Mr. Google, Googling tax questions from time to time, this has confused me. I'm putting these 2 tables here. So I'm looking at the capital gains tax table and just looking at that 15% tax bracket. So that's $78,750. Mm-hmm. Is that the amount of the gain from the capital asset that I sold, or is that my salary ordinary income? Like, what's this threshold measuring actually? That's, I've always kind of been hazy on this.
Yeah, it's a really good question. It's basically the amount of your capital gains. So if you had 80,000, well, that's I don't want to use that example because that's going to make me think a little harder than I want to. Let's say that you had 75,000 of capital gains. You're going to pay in that 15% tax bracket determined because you have 75,000 of capital gains.
Well, actually not, because it's only if it's over 78,000, right?
Correct.
So if I had 75,000 capital gains, I would not pay taxes on there, right?
I think you're right.
Yeah.
Well, assuming that you're married, right, and filing a joint return, that's kind of the other caveat running here.
Yeah.
But yeah, so actually my first example that I totally shied away from was the better example. If I had 80,000 of capital gains, I'm going to be paying that 15% tax bracket.
So whether I'm making a $50,000 salary or $200,000 salary, that doesn't really, it goes by the capital gain.
Correct. Yeah.
Oh, okay. So really, if you're selling something below, a $78,000 profit that you're married and filing jointly, you can walk away with that at a 0% tax bracket or 0% on the federal level.
Yeah, potentially.
Wow.
It's driven by a few.
There's probably a few other things in there.
There's calculations that are going to happen on the back end as well.
Okay.
But yeah, I mean, I think that's what we're looking at here. So anyways, there's your primer, kind of why it matters, capital gains versus ordinary income, right? Because it does have these preferential rates, and to be taxed at a capital gain rate is much better than taxed at an ordinary income rate, right?
Oh yeah, because even the final one on there is that married filing jointly, if your capital gains over $488,000, you pay a 20% tax bracket. If you're in the ordinary income, you're going to be like a 35 or 37% tax bracket.
Right. Yeah.
So
the
that's
higher,
a big difference.
It's kind of like anything else with the tax code. The more that you get into the higher incomes, the larger difference you're going to see, for better or for worse. So yeah, and there's AMT and other things that you have to consider, but just from a real low level, this is why capital gains matters, right? Why it's so important. So that's why it matters.
Can I ask you one more question? Move on next, because in the last episode we did 201, we went down kind of a rabbit's hole in self-employment tax. So if I sell an asset, a short-term capital gain asset, and I get taxed at ordinary income, am I going to pay self-employment tax on there as well? Or is that like a whole, it depends on 10 other factors type answer? Because then if you had 15% on there, that really jacks up the tax bracket.
Right. Yeah, it kind of does depend on a few other factors.
Okay.
Yeah, it's actually a really complicated question. And I just don't have a really great one sentence answer for you. But where my mind kind of goes is also passive rules, material participation. There's a lot that you'd have to potentially parse through to figure out the self-employment implications, as well as whether it's passive or not, and how much income you're actually going to be able to recognize, or well, not income that you're going to recognize, but particularly if you have losses, how much loss you're going to recognize moving forward. But the other thing is, the more that you're doing and the more that you're potentially triggering concerns about self-employment tax, the more that you may actually begin to look like you're having inventory versus a capital asset, which could blow this whole capital gain taxation kind of regime out of consideration, right?
Okay.
So yeah, there's a lot kind of moving there, but it's a really good question, Chris.
So potentially you could, potentially you couldn't. It just depends on other things.
Yeah.
Okay.
You should know, one of my favorite books coming out of law school was a book called Getting to Maybe. and it's basically how you just don't give a yes or no answer.
Sounds like such a lawyer book. I got one more question on here, because this is something else that's always been a little confusing to me. How does this work at the state level? Let's just say Colorado, since I think the vast majority of our listeners live here in Colorado.
Mm-hmm.
Is it similar with Colorado, or how does that work, since we have a 4.6 something percent tax rate?
Mm-hmm. No, it's a good question. The way that Colorado works is it's actually geared a lot by what's on the federal return. And so you kind of figure your federal return, and then you're going to carry over to the Colorado return your net income figure, and then make additions and subtractions. And sometimes there's additions and subtractions for capital gain. So it's kind of driven by what is triggering the capital gain and not. But by and large, by the time you transpose, I guess, kind of the taxable income figure from your federal return over to your state return, it's already taking this into account. Yeah.
Okay, gotcha.
Yeah. So yeah, I guess the simple answer is, yeah, Colorado gives you this preferential treatment, but it's kind of in a weird way, because they just take one line item from the federal return and then start modifying that. And the line item they're taking has already taken this into account.
And so does Colorado have a capital gains tax bracket, or do they just tax you at the flat rate or zero? I know I'm getting really nuanced here, and
yeah,
I've always been confused by this.
Well, it's kind of already taken into account, because the number that they're pulling over is basically your taxable income, which already takes into account kind of the way that this all runs through the ringer.
Okay.
Yeah, so there's not like another special bracket or amount or something like that. It's kind of like it's already run through the ringer on the 1040 for the federal purposes, where it's already kind of received this preferential treatment. Yeah.
Okay, gotcha. Cool. Thank you. Those are my two questions on here.
Very complicated questions, but very good. Once again, like I said, they're deep dive questions, and I love it. All right, so let's talk about actually targeting strategies, like looking at what potential investment strategy you have, and then maybe the tax fallout that follows from that, right? So the first one I want to start with is like a real estate broker or an independent contractor. And the reason that I'm lumping these two together is that they kind of work hand in hand. The income earned and the tax treatment of the income earned is really very similar. Both a real estate broker and independent contractor are going to get a 1099, either from the brokerage or from their client, and that's going to report how much taxable income they earned to the IRS. And so on a deal by deal basis, there's really no exits to speak of, because you're still in business. You're still kind of moving forward, and you're not really looking at exiting your strategy as a whole, right? But
and a lot of times you are the business. Like,
right,
I've built business in the past, and there was no exit strategy, because without me, there was no business.
Yeah, and that's kind of what I was struggling with as I was making this slide, honestly, because for the real estate broker, it's very difficult, because you kind of like look at the assets of the business, right? There's two potential ways, and I'll talk more about this. There's two potential ways where you're going to sell your company, when you're going to sell your company or exit your company, what you can do. You can sell kind of the company itself, or you can sell the company's assets, right? And if you sell the company itself and it's really just built around you and your reputation, and there's not a lot of value there if you're no longer there, right? And so the other way to maybe look at it would be, well, maybe you could sell your book of business, right? And maybe there's some value there. Now it's probably not a lot of value, but potentially there's some value there, and that's something you could look at doing. For the independent contractor, on the other hand, it may be a little bit easier because they could actually sell their company, right? And there's kind of some ongoing reputation and other things going along with that company that maybe gives it a little bit of value, because they're like the go-to roofing guys for the last 20-25 years, right? Or something like that. There may be some value there. So I kind of lump these together, and whether that's an inexact parallel, that's maybe up for debate. But I think what we're looking at here is, okay, can you maybe split up the company into several different assets that somebody may want, or can you sell the company as a whole, right? And so if we're looking at doing that, what I was saying here is like, okay, you can either sell the stock or sell the company itself, right? Or you can sell the assets. So if you decide you're going to sell the stock or the company itself, you're basically going to trigger, as the seller, capital gain for yourself. It's just like selling stock on the stock market, right? And so that's actually really beneficial to you as the seller because you're getting that preferential capital gain treatment, right? On the other hand, if you're going to go with the asset sale, and typically purchasers want this more, you're going to break up, the several different assets inside the business. And so you might have business equipment, tools, furniture, right, whatever it may be. And so generally, that's going to actually generate capital gain for the seller, unless you're depreciating it, in which case you're going to have ordinary income up to the amount that you've depreciated, but anything over that's going to be capital gain. So a little bit of a wrinkle there. But goodwill, when I'm talking about goodwill, that's just kind of your reputation, right? Is there kind of like goodwill associated with the company when somebody sees the name of the company? Do they get the warm and fuzzies that says, yes, I'm going to hire this company because they have a good reputation? That's kind of the idea behind goodwill. Any amount you can allocate towards goodwill, that's going to give you capital gain. Any intellectual property, websites, the name, trademarks, anything like that you may have, that's going to generate ordinary income. So when you begin to break down into all of the different assets, you're potentially triggering different tax impacts to yourself. And so you can see, kind of just based on the idea that capital gain is more beneficial, most sellers are going to want to sell the stock of the company or sell the company itself, whereas most buyers are actually going to want to purchase the assets of the business because it's a little bit better for them. So there's this constant push-pull, right? So I don't know, Chris, do you have any questions so far before I dig into this next slide? Or
no, I find that very interesting, that just the different line items, how some are capital gains, some are ordinary income.
Yeah.
Just interesting to me.
Yeah, well, the push-pull is even more pronounced when you actually look at kind of the impact to the buyer. So I've talked about the impact to the seller. The seller wants the capital gain, so they want to sell the stock. But the problem is that if the buyer is purchasing the stock, they actually don't get any depreciation on the assets.
So
right?
You're saying if I buy your company
Mm-hmm.
that has all these assets underneath it,
Mm-hmm.
I'm buying the company, you get capital gains, but then the assets in the new company, I can't depreciate those?
Right, because you're stepping into my shoes. And let's say that I have really old, crappy furniture that's like totally depreciated, and you buy that furniture off of me, and you buy the company that owns the furniture, right? You don't get to start that depreciation clock over because the company already depreciated it.
Oh, I follow that now. Yeah.
Right. And so not only is it like it's extra beneficial for the seller because they get this capital gain, but what it really does is kind of screw over the buyer, right? Whereas the buyer really wants to push for depreciation, right? They're going to shell out all of this money and they want to get those nice depreciation deductions. But the problem is that when the buyer pushes for that depreciation, that's going to reduce the capital gain that the seller is going to have because they're going to pick that up as ordinary income, right?
I follow you here.
Yeah, so it's really complicated in a way, but that's the push-pull, right? And so yeah, I mean, there's really not a lot more to talk about on this slide. I'm just kind of restating the other things here, but that's the push-pull here, right? And some people may say, well, so what? The seller can say whatever they want. They'll say that it's capital gains and report it as capital gains, and the buyer will just say, well, it's ordinary income on their tax returns, right? Well, the IRS is one step ahead, right? And they actually require both the seller and the buyer to file this form, the 8594, and these have to match perfectly, right? Or else it's an audit trigger. And so basically the seller says, out of the $500,000 that I sold this company for, 300,000 was allocated to the goodwill of the company, and I get capital gain on that. But 150,000 of that purchase price was actually for furniture, and so that's ordinary to me because I depreciated it up to however much, and so then the IRS knows exactly how you're treating that, and then they will check to make sure that everybody's just being consistent across the board. So yeah, so that's kind of selling the company. And really selling the company, I'm going to talk more about, say, fix and flips. I'm going to talk about rentals. You could look at selling the company associated with any of those investment strategies as well. But every time you're looking at selling the company, you're going to be looking at this push-pull, and you're going to be looking at reporting kind of correctly and consistently with the IRS.
Oh, so that same rules and logic applies to if I'm selling you, the company that owns 123 Main Street, versus if I just sell you the property directly.
Correct.
Oh, I never knew that.
Yeah, because if you think about it, let's just run with that example, 123 Main Street. If it's a rental, I easily could say, hey, Chris, I got this great rental. You want it? Here's the return, whatever. You may think that that's a really great property, decide to buy it from me. And then I have two options. I can either just sell you the property outright and then dissolve the company or reuse it, rename it for my next rental or, whatever, or I can just sell you the LLC and be done with it. And then you have an LLC, you're protected with the LLC protections and everything else. But yeah, we have to decide, are we actually selling the company or not?
But if I buy Peter LLC from you that holds a property, I don't get the depreciation if you've already depreciated the whole life of the property.
Correct. Yep.
Oh.
Yeah. Or if you're stepping in year 16 or something like that, you're not going to get the 16 years of depreciation that I otherwise took. The other thing to think about, and this is kind of aside from tax strategies, but the other thing to think about with that, if you are looking at buying somebody else's LLC, is that you're actually stepping into any potential liability that LLC may have had like 2 years before, right? And so actually, if a tenant, hurt themselves or whatever a year before you purchase that property, and they go talk to a lawyer and it's kind of all long and drawn out and whatever, but they decide to sue and you've purchased it in the interim, you just bought that lawsuit too, right?
Yep.
Yeah. So there's some liability concerns there too. Yeah. So let's move on to rehabs, right? Fix and flips. So exiting basically selling the property is the exit strategy, right? Again, there's not it's kind of like brokers in a way, because on a deal by deal basis, there's not a really great answer for what your exit strategy is really going to look like. I think the longer term picture is, well, can you sell the company? Can you maybe split up its assets into something that may be worth some type of value there? But either way, selling each parcel of real estate, that's really going to be on the deal by deal basis, where you're earning the money, also really where most of the value is. And I think it's similar to what Chris was saying, kind of your ability to do those rehabs, that's probably the most value associated with that company. And if you're going to walk away from that, the rest of the company really isn't worth a lot, right? And then there's further even more of those liability concerns, because somebody who maybe purchases that company in the future purchases any potential headaches with foundation settling or water in the basement or something that happens on one of these rehabs. So there may be limited value to the company itself. But the question here, and we've talked about this really in Tax 101 and 102, or 201 and 101, the last two classes, is the frequency, right? I mean, are you a dealer? Is it actually looking like the number of properties that you're selling in a particular year is actually your inventory? And if the answer is yes, well, then really your play is going to be to try to limit your self-employment tax. Right. And so we're going to try to limit the self-employment tax. We're going to plan around that. But other than that, I don't have a lot of really great exit strategies for fix and flippers or rehabbers, just because really it's going to be a deal by deal basis, and there may be limited value to the company itself.
So a few months ago, actually, probably last year at this point, I was talking with someone. He's a very successful investor around town. And I know one of the strategies he follows is he buys rentals, he buys fix and flips, and kind of does everything else that he can. But when he buys fix and flips, a lot of times is he'll buy the fix and flip. I'm using air quotes here, fix and flip, and then keep it as a rental for a year or two. And then after that year or two is up, once the tenant lease is out, get rid of the tenant, then go in the remodel the place, then sell it.
Mm-hmm.
And he says, well, I do that to avoid ordinary incomes. That way I push everything to long-term capital gains. And I've never asked a tax professional, but to me, that actually makes a lot of sense because hey, you're making some rental income and then you get to kind of shift the tax burden. And I believe at that point too, you could also then do a 1031 to defer the taxes, right?
Yeah, so we're going to talk a little bit more about 1031s. But yeah, typically there's a requirement with 1031s that they have to be held for the purposes of trade or business or investment. And the held for, those words held for have been picked over by the court again and again and again to try to figure out what the heck that means. And I think the consensus in the tax professional community, it's not anywhere in the code. It's not anywhere in case law that I'm aware of. It's just kind of where we've landed as a community is that you have to hold it for at least 2 years beforehand and then hold it for 2 years after to kind of qualify for that 1031 treatment.
Really?
Yeah.
So basically about 2 years before. I say that again?
Yeah. So like if I hold the property for say 6 months and then decide I'm going to 1031 it, I think that won't be allowed.
Okay.
Because I'm not holding it for the purposes of investment with only 6 months under my belt. See what I mean?
Yeah.
So I think on the front end, you have to hold the property for 2 years is kind of where the tax community has landed. And if you've held it for that 2 years, then you're holding it for purposes of investment, right?
Okay.
And then that qualifies you to then take advantage of the 1031. And then there's actually a holding period on the back end to qualify for that same treatment to say that it's held for investment.
I'm getting confused on the back end.
Yeah.
So if I buy a place, hold it for 2 years, sell it, and then I buy rental property B, I need to hold rental property B for 2 years?
So hold property A for 2 years, right? Then 1031 it.
Yeah.
And you're going to wind up with property B.
Yes.
Right? Hold property B for 2 years before you sell it, before you transfer it to another company you own, before you 1031 again. Right.
Okay.
I mean, there's kind of like a holding period on the back end. And by back end, I just mean after that initial 1031.
Okay.
Right. And the reason is because if you're so you can't 1031 inventory. You can't 1031 something that's not held for like purposes of investment or trade or business, excluding inventory. And so when you quickly turn around and do anything with these properties, be it kind of within that initial 2 year period before the 1031, the problem is that it's not, if you violate the 2 year rule there, you're not holding it for purposes of investment is the argument that the IRS is going to come up with. And so by definition, that property cannot be 1031 exchanged.
Okay.
Right. On the back end, if you quickly get rid of it, well, the IRS is going to argue, look, you still weren't holding it for purposes of investment. Right. And so it's that long-term play, and just kind of where the tax community has landed is that long-term quote unquote is going to be 2 years.
I might have to get you back in here with a 1031 QI.
Sure.
A lot of times I've heard them, they say they kind of use 1 year.
Is that right?
That's what I've, a couple I've talked to and just read online.
Yeah.
I believe I kind of hear that 1 year rule. So,
well,
you guys are probably both right on some aspect. That's
exactly what I was saying is like, look, the 2 year kind of rule of thumb that I'm using here, as far as I know, is not written into the code. It's not written into the regulations. It's just kind of where the community has landed as kind of being safe. Right. And so this is not a knock against the QIs, the qualified intermediaries at all. But if you think about it, they're out there trying to drum up that business and move it. And so they're probably going to be a little bit quicker than somebody like me, who's probably going to be a little bit more conservative because I don't really have a dog in the game. It's like, look, let's just try to keep the IRS off our backs, Okay. So you're probably getting the conservative answer with me for sure. Yeah.
So let me kind of just because I kind of went down a rabbit's hole by throwing in that 1031 exchange on the back end. So let me go back to just if I buy a property,
Yeah.
I go out there and I buy a property that it needs some love and it's seen better days. Buy it for a year, or I buy it, put a renter in there, then after a year when the tenant's out, go in there, spend a couple months rehabbing it, then turn around and sell it to an owner occupant for getting a 1031 exchange. Have I just shifted that to a long-term capital gain?
If it's your only property, the answer I think is yes.
Okay.
If on the other hand, though, you have to look at kind of you as a whole and your investments as a whole, because if you're actually switching into that role of more of a dealer, and the kind of turnaround of your properties is such that maybe you've done 3 in 1 year, 2 in the next year, now you're going to have 4 this year, probably looking like dealer, right? Because you just have a lot of deals, and kind of you're over that 3-year term, you're actually transferring a lot of properties, right?
Yeah.
On the other hand, it's like if this is your first year doing it and you only have 1 this year, and then maybe your second year doing it and you only have 1 that year, you're probably not a dealer yet, right? And so you've probably successfully switched that over into capital gains, right? But I guess you have to look at the whole picture, how many deals you have, and then kind of look year over year, how many deals are you doing? Because I think there does come a point kind of under it, the way that the court kind of looks at it, or the words of the court would be the totality of the circumstances, right? Or the totality of the facts. If you look kind of at the whole picture, are you crossing over into that dealer category?
Okay. Because I'm very intrigued by this model. But if I extend that holding period to 2 or 3 years, then I can 1031 it, which is probably in my eye, the best scenario. But if you keep extending that gives you more options and shifts it more to 1031 possibilities and long-term capital gains possibilities, and minimizes the dealer status. Am I butchering this close enough to make sense?
Yeah, I think okay. You've got it.
Because this is all very intriguing to me. And I think this is one of those things where if you learn this stuff, I'm much more intrigued by how can I maximize profits and revenue by, knowing the tax code versus, doing a bunch of flips or anything.
Right.
Because to me, this is the kind of like the less physical sweat and having to do work.
Right. Okay. And for everybody on the call, we're going to talk more in depth about the 1031s. And so I hope I didn't lose anybody there, kind of in the meantime. We'll get there, and I think that'll make a little bit more sense in a few minutes here. But either way, Chris, I think we'll look at pairing 1031s and really kind of the ultimate exit strategy, which we've already talked about in 201, which is to die. And if you actually successfully do that, which all of us will at some point, but if you 1031 and 1031 and 1031 and die, then that's actually a really good tax impact or tax strategy. And we'll talk about why that is. So
death and taxes, these things you can't avoid, right?
Right. Yeah, I love it. People keep coming to my office, and it's because you can't avoid it. Yeah. All right, well, let's talk about rentals. So possible exits here, right? You're going to sell the property is one way to exit your rental strategy. In that case, you're going to look at capital gain, most likely. Well, it will be capital gain. The question is whether it's short-term or long-term. I think for most people, 99% of people, it's going to be long-term capital gain. You're going to be over that year of holding that property just because you're probably going to have a lease for at least a year under most circumstances. But there is an option here to go through the effort of seller financing, right? And there's a lot of confusion about seller financing and kind of the tax impacts and things. The easiest way to think about it is you're really just spreading out the time where you actually recognize the income. You're only picking up the income as it's paid to you over the payment plan or the payment term, right? And so I've seen people say, oh, well, I don't want to have to pay all the capital gain without the income in the first year. And it's like, well, that's not really what seller financing is. You're actually spreading that out. So it's a potential strategy. The other strategies available to you here are the 1031 exchanges and then the opportunity zones as well. And so I'm going to dive deeper into each of those in the following slides. But really with rentals, I just see these 3 potential exit strategies, right? So let's talk about 1031s. We've already kind of danced around this a little bit, but what is it? Basically, with the 1031 exchange, you're not recognizing gain or loss when you exchange qualified property. And what's important here is that you're exchanging the property, the rental property, for property that's of a quote unquote like kind. Well, what is like kind? It's actually a really broad definition. And so here we're just talking about real estate for real estate. So you can go from vacant land to an apartment building. You can go from that same apartment building then to a shopping center, right? You could actually go just from the vacant land to the shopping center. All of that's going to be considered like kind. The only real exception that you need to think about, I think, is U.S. land, like land located here in the USA, is not like kind with foreign land. For some reason, Congress thinks that our land is worth more or inherently more valuable. It's just not like the same outside of the U.S. borders.
Well, I would imagine I would think that's more from just they won't get their taxes in. If I sell a piece of land here and buy it in wherever, I know, Australia,
yeah,
then I sell that land down the road, there's a good chance the U.S. government's not going to get their deferred taxes.
No, I think you've landed on the real reason, but I like to think of Congress as thinking, that the U.S. land is just inherently more valuable. Yeah. But what we're not talking about here, what does not qualify for 1031 treatment is inventory or your personal residence, right? And so I can't 1031 out of my house, for instance. And then for flippers, you're not looking at flipping and 1031ing with each flip, right? It's an interesting question that comes up every now and then, but you're going to trigger ordinary income really on your inventory if you're a flipper.
And really with your personal residence, I mean, if you live there for 2 out of the last 5 years, that capital gains exclusion rule,
yep,
you're getting one of the best gifts ever from the IRS with that.
Yeah, that's exactly right. And actually, Chris, that brings up a point that I've done a couple client meetings actually where we've talked about different strategies for people who are looking at turning their personal residence into a rental, right? And you actually have to weigh. I'm really glad you brought this up because otherwise I would never have talked about this, or I don't have a slide for it. But if you're going to convert your personal residence into a rental, you're going to give up that capital gains exclusion. And so if you're a married couple, what that capital gains exclusion is you can take $500,000 of capital gain off the table. It'll never be taxed, right?
So just to clarify, assuming, let's just say, so back in the 1978, my parents bought the house that I grew up in. They still live there, for, $100,000 bucks.
Mm-hmm.
And now they sell it and it's, worth $700,000.
Mm-hmm.
So 700 minus 1 is a $600,000 gain.
Mm-hmm.
And they would be able to take about $500,000 off the top and pay no taxes on there.
Correct. Yeah. In your example, if there's $600,000 of capital gain, they're only going to pay capital gains tax on the $100,000 that wasn't taken off the table by this $500,000 exclusion. Right?
And that's why it's such like an amazing tax benefit.
Absolutely. And so I had a client who was actually looking at creating an LLC. She was going to put her personal residence into that LLC, and then she was going to rent it out and then use the rent from the rental property to then pay a mortgage on a smaller property for her to live in. Right.
Okay.
Which is a really interesting idea. I actually kind of like it. But the problem with that is that she's never taking advantage of that $500,000 capital gain exclusion. And so I explained that to her and said, look, you can 1031 in the future. You can kind of defer the tax bill and push that out into the future. But if you were to just sell the property now, purchase a property that is kind of like it and use that as a rental, you can actually just take that $500,000 off the table and never pay tax on it, which is actually better than the 1031. Because the 1031, you're just kicking the can down the road. With the capital gains exclusion, you're never paying tax. You never even kick the can. Right?
Yeah.
And so anyways, it's a really interesting interplay between those. And so if you're looking at doing that, and by that I mean turning your personal residence into a rental, you might actually consider just selling your personal residence, taking advantage of the capital gains exclusion, and then purchasing with the proceeds of that sale, purchasing another residence that's kind of like that, and then using that as your rental. Yeah. So hopefully I didn't lose anybody on that. That's a little a little esoteric and no slides to kind of help us step through it. But
I know, I think you did a great job explaining it.
Yeah.
And again, before you do any real estate deal, talk with your tax guy.
Right. Yeah.
Because as I've learned, there's 10 different things you never think about. And like, oh yeah, I need to consider that too.
Right. Right. So basically, visually, this is a good breakdown of what a 1031 exchange is, right? And so let's say I'm just keeping the numbers really easy here because it keeps my mind limber when I go back to the office. But on the left here, we kind of have our first property, right? And let's just say that it's worth $1 million. And I have $550,000 of equity in that property, and I have a $450,000 loan, right? If I 1031 out of that property, basically I'm just transferring my equity to the second property. And so I can buy a $2 million property with that 1031 exchange. I just shift my $550,000 of equity over to that new property, take out a new loan to help me get the new property. But I never pay tax on the transfer of that $550,000 equity. It's like I never sold the property. I just exchanged it out for a new rental property, right?
Yes.
Yeah.
And so basically, I mean, you're using the equity, which is, what you'll walk away with minus some selling cost. You're using that as the down payment on the new property.
Yes. Yeah. Right. Without ever paying tax on it. Yeah. Now, when I then sell the second property there, that $2 million property, my basis in the sale is actually going to be the same as my basis in that first property. So that's where you get hit. That's where you're actually going to pay tax, is when you exit out of that second property. But what a lot of people do is they just continue to 1031, just 1031 all the way up until they pass away. And we'll talk more about that with estate planning strategies. But in a nutshell, that's what a 1031 exchange is. And so just a few more details about how this works. You have to use a qualified intermediary. So we were talking about the QI before, and that's basically just an outside company and a person who's really, very well experienced in the world of 1031s will help you through the process. But what they basically do is help you step through all of the requirements of the tax code, and the regulations actually do require that you use one of these qualified intermediaries, so you can't do it yourself. But at any rate, the qualified intermediary is going to help you with identification of the replacement property and then also your timelines. So the way that identification works is that you have to put it in writing, and that has to be with your qualified intermediary. And then there's these 3 rules that you kind of have to abide by, which is that when you're identifying what your replacement property is, you can choose up to 3 properties, and those 3 properties can have any value. Or there's the 200% rule, which just says you can identify any number of properties so long as the aggregate fair market value doesn't exceed 200% of the property that's being exchanged. So there's kind of a top limit, but you can have as many properties as you want kind of identified there. Or there's the 95% exception, which says you can identify any number of properties so long as 95% of the properties identified are then actually purchased, right?
How did they come up with 95%?
I think it's some congressional staffer at like 2 a.m. with way too much coffee in their system. And, like kind of thinking through how this is going to work. And then the congressman actually looks at it and says, I don't get it, but it sounds good to me,
So I'm going to put just a quick note for all the nuances of 1031s, and there's different types of 1031s. You can do reverse ones and do some other really creative stuff with them. Many episodes ago, I did a very long and in-depth interview with Chris Sayer, who's a local QI here. If you guys want to get the details of the 1031 and all the different strategies and really specifics on the nuances of it, go listen to that. Because he talks about that, where Peter talked more about the taxes, and that's like an hour and a half deep dive into the 1031 section or 1031 aspects of everything, which is, if you're a real estate investor, you learn it because it is a powerful tool.
Yeah, it's one of the most powerful things I think you can do under the tax code, actually. But yeah, I'm coming at this from a very high 10,000 foot perspective, yes. And listening to that other webinar absolutely would be. I may even want to do that because I know it, as I said, kind of from that 10,000 foot level, but because I am not a qualified intermediary, I just don't dive down into the weeds on this stuff.
And the other thing, you talked about, you must use a 1031 QI. Peter's absolutely correct. And something you cannot do, because I've seen people make this mistake, is you cannot collect the money from the property you're selling. Your QI, who's an independent person, they have to hold it. from my understanding, basically, if you touch that money, you can no longer do 1031 and you're paying taxes.
That's right. Yeah, they call it taxable boot. And basically anything that you manage to lay your hands on becomes that taxable boot. So yeah, you just use a qualified intermediary. Don't even go down the path. You can't go down the path of anything else. So timelines, basically when you close on the sale of the first property, you have 45 days to actually identify what your replacement property is. And again, that identification plays back into this 3 property rule, 200% rule, 95% exception. But anyways, you have 45 days to actually identify your properties. And then you actually have 180 days from the close of your property to actually close on your replacement property. So these timelines are absolutely set in stone. There is no leeway around any of them. And that's why, once again, working with a good qualified intermediary is really important, because they're going to keep you honest, right? They're going to make sure that you're actually on the timeline to meeting these timelines. So yeah. So stay on the good path when it comes to this, because as Chris says, if you work outside or get outside of kind of the framework here, the IRS is really unforgiving. You're going to pay tax on it. You're not going to qualify for that 1031 treatment anymore. So
before we move on to this,
yeah,
can I ask a couple questions on 1031s?
Sure. I'll try my best to answer. Yeah.
So something, just because, I'm doing, for me personally, my first ever 1031 for investments I own. So it's been, huge learning experience. I've, help clients do it as well. And something I want to ask you, it seems as I've run numbers with myself and clients and everyone's respective tax people, that if I'm selling a 1031, or if I'm selling a property for, let's say $300,000, because this is I'll use kind of set this up for a common scenario we see here in Denver, is, people bought a property 10 years ago, for $180,000. Now it's worth $400,000, or they bought it 20 years ago and then got married, turned to rental, whatever. They've seen a huge appreciation gain. Now, if I sell that $400,000 property, there's really no benefit from the numbers I've seen on 1031 if I just take that as cash and go buy a property of similar value. It seems like the real benefits of 1031 is when you use a large portion of that money as a down payment to leverage up into a bigger property. Is that conceptually correct as a rule of thumb?
Yeah, I think that is, but it could also depend on your investment strategy, because I also have a lot of clients, who are looking for cash flow. And so in a way, like, more properties are beneficial to them versus one single property. And, so for instance, I was talking to a client 2 days ago who decided to invest in Cleveland, because in Cleveland she could pick up 3 rental properties for hardly the cost of what it would be for one property here in Denver. But the cash flow coming off of the 3 properties was a better play for her in terms of where she was in life. And, she's kind of slowing down, looking to retire, and needs the cash flow more than the appreciation. And so you actually could 1031 one property here in Denver into 3 properties, say out in Ohio or something like that. And kind of split your equity over multiple properties and then get more cash flow that way. So kind of depends, right, on your overarching strategy and maybe what you want to do. But, 1031s can go a lot of different ways. Yeah.
But it seems like the maximum benefit, maybe this is just, I'm kind of tilting this towards where I'm at, where I'm just in acquisition mode. I just want the more properties I get now, the better. Right. And cash flow is not my major concern, because the more properties I have now, the more cash flow I have in 20 years for retirement.
Right.
But it seems like the most powerful benefits come from selling it and using the vast majority of proceeds for a down payment to leverage up, whether that's $400,000 on down payment for a $1.3 million apartment building or buying 5 rentals individually. Is that conceptually sound about right?
Yeah, okay. I think that's absolutely right. Yeah. Particularly, as you say, kind of for your stage and where you are and all of that, and probably for most of our listeners. So
I got one more. That was my first question. Okay. Get your hand away from the keyboard, Peter. In like hour 3 of our last episode, when we were talking about cost segregation.
Yeah.
I don't know if you've even had a chance to look up. Probably not. So I kind of asked you about, a strategy I had this, shower thought on is, hey, I'm buying this more expensive property of, $850,000 fourplex. And if I do the cost segregation with all the other like bonus depreciation stuff out there, whatever, to like really front load that first year.
Mhm.
From an online calculator, I could walk with like $150,000 appreciation, or tax benefit that first year, and probably walk away with like 30, 40 grand in a tax refund, or one way or the other.
Yeah.
Now, were you able to find that if I front load all that stuff, and then later I do all that, then 10 years later at 1031 this property,
Yeah.
is that front load depreciation going to be counted as, I think you call it the boot, and I pay taxes on there, or can I continue to roll it over?
Yeah.
Or is this just like way too complex to ask you off the cuff?
Well, no, it's not way too complex. Well, in a way, it is way too complex to ask me off the cuff. I don't take offense to that, or I'm not like, oh my God, what is Chris doing?
I want my free tax advice.
These once again are the questions that I love, because they actually get me thinking. But to be honest, Chris, after all that setup, I still have not had time to look at it.
Okay.
And so I think my answer is still the same as it was in 201, with the caveat and the asterisk that really somebody would need to do the analysis to be sure that my gut instinct here is actually correct. But I think, under normal circumstances, if you depreciate and then you sell the property and you've taken more depreciation than you otherwise would be entitled to because of special programs like double declining balance makers and other things, where you're basically front loading more depreciation than you otherwise would on like a straight line amortization or depreciation schedule, you have to pick up the extra depreciation, the quote unquote extra depreciation, because you've benefited more than you should have, right?
Okay.
And they call that depreciation recapture, right? Depreciation recapture is typically taxed at an ordinary income rate, right?
Yeah.
And so basically what you're asking is like, well, if I front load a ton of depreciation and then I exit, well, to me, that's almost like recapture, right? And so, yeah, you might be 1031ing, but I wonder if that recapture is actually treated as boot.
Yeah.
Right. The other potential answer here is no, it's not treated as boot, because really all you're doing is kicking the tax liability down the road. And so your basis in the original property is going to be your basis when you sell the replacement property, and maybe it's taken into account there.
Yeah.
Right. It's only going to be taxed once. And so I think if you this is getting really into the weeds, but you can see kind of how sickly my mind works here. But basically, if you pay the ordinary income on the recapture, it's not going to have an impact on your basis, because then you're not going to be double taxed. If you don't pay the tax on the recapture, it's actually going to reduce your basis, and you're going to pay more tax when you exit out of the back end, because that's how they're going to tax it. So it's only taxed one way, but it's going to be taxed one of those two ways.
Yeah.
Yeah.
But it's not really up to my choice. It kind of depends on.
I think the answer is there. It's just what the answer is, I don't know off the cuff.
Okay. I'm going to follow up with you on this, because this is actually something I'm very interested, nothing like this week, but I'm very interested in just, hey, if this is a way to pull extra cash to buy more properties. So I'm sure probably like 3 other people are still following us at this point, listening to this.
Right.
I'm going to follow up with you on this, Peter, and
Chris,
at some point get an answer, because I'm really intrigued by this.
Please do follow up with me, because what happens is I think that's a really great question. I'm going to actually look at that, and then I go back to the office, and then a billion things like pull my attention.
Do real work.
Well, yeah, because then I'm catching up on email because I missed the morning, and I had the IRS in all day yesterday, so I am already behind on email, and by the time I actually catch up, it's already out of my head. So yeah.
No, okay, cool.
Well, but do follow up with me.
I will, and I'll post the answer later in the show notes or the blog post somewhere.
Yeah, that'd be great.
Okay, so opportunity zones.
Yeah, Chris, how familiar are you with opportunity zones? Just off the cuff.
I actually am fairly familiar.
Good.
And if we have regular listeners, a lot of them are too. Just so you know, a few months ago, we did an in-depth podcast on opportunity zones.
Great. Okay.
With actually a couple of investors that are actually doing some opportunity zone investing.
Great.
So they talked to a lot of people about research. They're not tax professionals,
right?
But they were kind of sharing what they've learned, and a couple properties that actually doing in the ozone.
That's great. No, that's really wonderful, actually, because most people still have not heard of this program, or their understanding is really basic. And once again, I'm keeping this at a pretty high level just because we're talking about so many things today. I do a presentation just specifically on opportunity zones that kind of does a deeper dive. But either way, I'm glad that maybe we're engaging at a higher level than maybe otherwise we would. So, I mean, for those who don't know, The Opportunity Zone program at its most basic is really what we're seeing here. Taxpayers can get capital gains tax deferral and forgiveness for making timely investments in qualified opportunity funds, and those funds actually invest in qualified opportunity zone property. That's the program at its most basic. And that first circle there is almost like a 1031 exchange. You're getting capital gains tax deferral, but this actually goes one step further than the 1031 exchange, because you're actually going to get capital gains forgiveness if you take advantage of the program as a whole. So we'll talk more about how that actually works. But there's really three benefits to this program. Benefit one is that you're deferring a portion of the gain, and the period of capital gain tax deferral basically ends either when you sell the property or at the latest December 31st, 2026. So this is really important because it's like a 1031 exchange, except that at December 31st, 2026, you're actually going to pay tax at that date. Right. So the deferral actually ends. And
so regardless of what year I buy the property, whether I buy it in 2018 or 2020, I still have this 2026 deadline.
The way I understand it, yeah,
Okay.
That's absolutely true. Now, there's been a few developments and a few regulations that have come out really in the past month or so. And I haven't had a real chance to do a deep dive on those regulations. But the way that I understand the program now is that, yeah, December 31st, 2026 is a hard out. And you have to pay the tax at that point. The reason I have earlier sale on there is because let's say you actually trigger the sale in 2019 here, and then you defer, but in 2023, you get out of your opportunity zone investment, you're going to pay the tax at 2023, right, rather than 2026, because it's just whenever you exit or the hard out at 2026.
Gotcha.
Yeah. So that's benefit one. You're kind of doing that deferral just like a 1031. But benefit two is you actually get partial forgiveness if you've held the property or held the opportunity zone property for less than 10 years. Now, an example is coming on this, so don't get really stressed or try to write this out really fast or something. But basically, in years 0 to 5 of your investment, your basis in the opportunity zone fund is 0. So you're only deferring gain. You're not getting any forgiveness in years 0 through 5. Now, years 5 through 7, your basis in the Opportunity Zone Fund actually increases to 10% of your deferred gain. So what that translates into is actually 10% of the gain that you're deferring is actually forgiven. And then year 7 to 10 of your investment, your basis actually increases to 15%. So what that translates into is 15% of your gain is actually forgiven. Right. So there's kind of this forgiveness component to it that otherwise wouldn't be there. Benefit 3, if you actually hold it beyond year 10, your basis is actually increased to the fair market value of the amount that you're deferring. And so basically all of the gain that you're deferring is basically forgiven. You don't ever have to pay tax on it. And so let's take a really quick look at what this actually looks like kind of visually, because I think this is a lot easier. So what we're looking at is you actually make a sale, right? You sell an investment, and it has to be capital gain. That's really important. You can't get out of, say, a flip or something like that and then get into this opportunity zone. It actually has to be capital gain. So we're really talking about a rental, right?
Or well, I mean, could you do like sell stocks as well or business? Because that's the interesting thing where it's more benefits than 1031. So if I sell I wish I had my $1 million of Facebook stock.
Right.
If I sold that.
Right. Yes, that's absolutely true. And kind of in the larger presentation that I do, I have this whole opening perspective about what Congress is actually trying to accomplish. And what it boils down to is Congress looked at the markets in general and realized there's about $3 trillion of capital gain in every market kind of just locked up. And so what they want to do is they want to reallocate some of that wealth, basically get people to trigger the sales, reinvest the $3 trillion and move it from, say, the stock market or something like that actually into economically depressed real estate areas.
Okay.
Right?
Wow, that's a lot of capital gains locked up.
Yeah. And so they're trying to tap that. Yeah, absolutely. And so it's not only like a redistribution. What's really interesting is not only a redistribution of wealth in terms of markets, like say from the stock market into real estate, but it's a redistribution of wealth of like traditionally very wealthy centers into geographically kind of depressed areas. So it's also like a geographic redistribution of wealth as well. It's kind of unprecedented. I don't think I've ever seen a program like this. It's really cool. But either way, so you sell a capital gains investment and you have 180 days to funnel your capital gain into a qualified opportunity zone fund and make your investment into the qualified opportunity zone, right? And so the first kind of point here is benefit one, you're deferring that capital gain all the way out until December 31st, 2026, right? If you hold it for 5 years, your basis is zero in the opportunity zone. And so if you sell within those 5 years, you're going to pay tax on the full amount of the capital gain that you're deferring, right? But if you hold between 7 and 10 years, your basis actually increases to 10%, right? And so 90% of what you're deferring is actually going to be taxed. 10% you've completely sheltered from tax, right?
Yep.
If you hold it beyond 10 years, that actually increases another 5%. So now 85% is actually going to be taxed, and 15% is now sheltered, right? Now, December 31st, 2026 happens. So you're going to pay tax on the amount of the deferred gain that you have, right? Minus that 15% basis that you have. But now your basis is equal to the fair market value of your investment, or the fair market value of the capital gain that you otherwise triggered. And then you're at benefit 3 here. And I haven't talked about benefit 3 yet, which is that any additional gain is going to be forgiven.
So after that 2026,
Yep.
when I pay taxes, whether I hold on for 5 years or 20 years,
yep.
Whenever I sell it at that point, all that extra gain I get to keep for free. I don't have to worry about doing 1031.
If you, let's say that you held the property for 20 years, right? At 2026, you're going to pay the tax on the capital gains that you deferred, right? But then there's no further tax bill associated with any further appreciation of the property.
And that comes back from, just to make sure, that comes back from my original capital asset sale. So if I sell my $1 million in Facebook stock,
yep.
and I have, let's just say I sell 1.1 million, I have $1 million in gain, because I bought Facebook at the right time or whatever. So in 2026, I'll pay capital gains tax on 85% of that $1 million amount. But then that $1 million I used to buy the new property, whenever I sell that new property, I pay zero taxes on.
Right. Let's put numbers to it.
Yep. Perfect. I should have waited 1 second.
No, it's okay. It's okay. But I'm a little more conservative. I say, well, okay, $100,000 of net profit, right? But rather than
I dream big.
But yeah. But either way, on the sale, right? Okay, you have $100,000 of net profit that you're walking away with, right? If you invest that $100,000 into the Opportunity Zone Fund, during the first 5 years, there's no forgiveness. So you'd pay tax on the full $100,000, right? But
if I sell the property.
If you sell the property in that time, right? Then hold it for 7 to 10 years. Well, you're actually going to only pay tax on $90,000 rather than $100,000 if you sell then, right? If you hold it for 10 years, then it actually increases another 5%. So you're only going to pay tax on $85,000 rather than $100,000 if during that time, right? Well, December 31st, 2026 happens. If that happens, you're going to pay tax on the $85,000. This is important because if you're going for benefit 3, you actually have to come up with the money to pay the tax on the $85,000 from some other source, right? Because you're not actually selling your qualified opportunity zone investment to pay that tax bill. Do you see what I'm saying there, Chris?
Yes.
Yeah. Okay. All right. But then, moving forward, benefit 3 here, let's say that the investment as a whole actually appreciated to $200,000, right? Well, I'm only going to pay tax if I sell in year 11 or 12 or whenever it is. I'm only going to pay tax on the $85,000 that I paid in December 31st, 2026. The additional appreciation up to $200,000, I'm walking away with that without ever paying tax on it.
So you're paying tax on $85,000 twice?
No. Just at December 31st, 2026.
Okay.
And then beyond that, I never have to worry about it.
Okay.
Including the appreciation up to $200,000. I'm walking away with that with no tax bill.
Okay. So you're saying the additional appreciation, you get it tax free, and the only taxes you ever paid was that taxes on the $85,000 at the end of 2026.
Correct. Yeah. Thank you for clarifying that.
Well, this stuff is
very complicated,
very confusing. So I got some very high level questions on there once you're done with this.
I think it's a good time for the high level questions.
So and I talked to a couple, I say very smart investors who kind of hopped on this stuff right when it first, the word came out.
Yeah.
When I think they said like the 3 paragraphs came out in the tax code and they were kind of waiting for all the other IRS to actually write out the pages of all the details of it.
Right.
They already figuring out and looking at details. And, I think it's like 20% of Denver's and the opportunity zones. There's a lot of potential here. But from talking to a lot of people, and I've seen a lot of chatter online, I've talked to a lot of people just in person on the phone. Everyone's talking about the opportunity zone.
Mm-hmm.
But I've seen I only know so far one person or one company investing in there. Again, not that I have a huge network here, but it seems like to me for I'll say the average investor, like the mom and pop investor, people like me, a lot of the people that listen to the podcast, this almost just seems like this is just too complex or too big because there's so many moving parts to it, with either having to find the property or one of these opportunity fund investments. And someone said to me, hey, this is more of probably geared towards much higher net worth people. Do you have any feelings on that? Or?
Well, I think this is even more powerful than a 1031.
Yeah.
Because of benefit 3. Because of the fact that any additional appreciation is never taxed, you potentially could walk away with a lot of money that really escapes taxation. It's really astounding. But that said, there's some built-in assumptions that's going to go along with that, which is that there's going to be significant appreciation of the property. Keep in mind, these opportunity zones, they are economically depressed areas. That's the whole idea and why Congress is trying to actually funnel these monies in, right? And so if you have I think the best case scenario in a way is find a really good opportunity zone with a nice little, let's say, even if it is economically depressed, it has a nice little downtown area with a few kind of historic buildings or something like that, whatever. But you and maybe 3 or 4 other investors decide that you're going to buy up one side of the main strip, right? And then each of you is going to funnel in a certain amount of money and, whatever. And kind of working together, you revitalize almost single-handedly like this little downtown area or something like that. Well, then you might actually be looking at quite a bit of appreciation, because then that's going to spur other investments in, because other investors are going to look there and say, holy cow, look at this, and whatever. That's, but yeah, there's kind of an assumption built in, which is that there's actually going to be appreciation. And if you're looking, this is not a knock against any of the real kind of remote areas of Colorado, but there may not be a lot of appreciation associated with a lot of these properties, right?
And aren't there rules too that when you buy the property, don't you have to put in a certain amount of investment to the property, like to redevelop or rehab it? Like there's other rules too than just parking the money on there. You have to.
That's absolutely
add
correct.
Value, right?
Yeah, you are adding value, and they're looking for there's a whole section in there about significant improvement. So we're not looking at coming in and kind of buying a distressed property and leaving it as that distressed property. We're looking at true revitalization.
Yeah, you can't just come there, park the money, wait 10 years and pull it out. You have to do some stuff in between and probably inject some more cash or capital.
You're right. Okay. Right. Yeah, absolutely. That's true. Yep. Yeah. There's a lot of moving pieces to this. Again, I'm coming in at that really high level. But if this is something that interests you, and you think that you might, kind of number one, be interested in it or have an idea of maybe where this might work or how this might work, talk to your tax professional, right? Because it's potentially really powerful. But I think Chris is right. There's some assumptions kind of built into this that you have to work your way through.
And if any listeners are out there are doing opportunity zone investing right now, I would love to chat with you for a few minutes, kind of see what you're up to. Just because, like I said, I know a lot of people talking about it. I know only a handful of people actually doing anything. So I'm very curious about this.
Right. Right. So if you go to this URL here, choosecolorado.com, some other kind of words there.
Just Google Colorado Opportunity Zones and the website will pop up.
Yes.
That's what I've done in the past.
The Colorado Office of Economic Development is kind of the official source kind of running this. And this is a map taken directly from their website, but they have an interactive map that you can zoom in on and whatever, and kind of identify where these opportunity zones are. They're highlighted in yellow there. But just to give you an idea of where they are around the Denver Denver metro area. There's quite a few designated. And a lot of people, as I've done this or kind of had talks about this, a lot of people were surprised to find out, yes, there are actually opportunity zones up near Boulder. So something to think about there.
So I'm just going to read off the map here. So we got some up near Boulder, Superior, Louisville, Lafayette, big chunk of land kind of northeast of Brighton, a little bit of southwest of Brighton, pockets of Westminster, Arvada, big strip from looks like Colfax or so, all the way north upwards into Thornton. Maybe that's not Colfax. Some stuff in Aurora, big area just south of the airport.
Yeah.
And that's a whole other interesting thing going on there called the Aerotropolis development.
Mm-hmm.
Google that if you guys want to go down a fun rabbit hole. Out by Golden, out by Lakewood, and then like Littleton, Inglewood area.
Yeah, it's kind of that like a little bit west of that, kind of like that Oxford, Sheridan, kind of around in there. But yeah, essentially Littleton and Englewood there. I think that swath up there in Aurora, kind of up to the airport there, isn't that also where they were looking at putting that racetrack for a while?
I don't have anything about a racetrack. I don't know.
Oh, really?
Yeah.
Yeah. Well, I grew up in Indianapolis, so the Indy 500 is always a little close to my heart. I'm not a huge racing fan, whatever, but sometime in May, kind of around the Indy 500, my redneck comes out, and I want to take a look at that. So when they were talking about putting a racetrack out here, I was like, oh, that's interesting. Yeah.
I've not heard anything about that. I've just heard about the Aerotropolis development, which is.
Well, the racetrack fell apart. That's probably why you didn't hear about that deal. But
I also don't care about racing. So.
There you go. Yeah.
To be very frank,
yeah,
I know nothing about cars, nor do I care to.
Fair enough. Fair enough. Well, let's talk really quick about estate planning opportunities. We'll kind of finish up here. This is my last topic, but talking about the 1031s, this is a really great plan, except that you have to die to take advantage of it. But what we're talking about is 1031ing and continuing to 1031 and continuing to kind of move your equity forward, never paying tax on moving the equity forward, and then passing away. Because what you actually do when you do that is that your beneficiaries get what they call a stepped up basis. And what that means is that when they sell the property, their basis in the property is actually the fair market value on the date that you die. So if you pass away and they immediately sell that property, their basis is equal to the sales price, and there's no gain that they have to recognize there, and therefore no tax they have to pay. So if you kind of sling your equity forward and go from $550,000 in equity, and that appreciates up to $700,000 in equity, and you sling that forward into the next property, and then $700,000 of equity kind of it grows to $1 million of equity, and you sling that into the next property, and then you pass away. What they can do is they can actually sell that $3 million property there, the one furthest on the right, pay off the loan, and they walk away with $1 million of equity that was never taxed. So the money grew from $550,000 up to $1 million, and no tax was ever paid on that. Right. And so that's a huge planning tip for families. But the one downside is that you, as the investor, you do have to pass away, and you're not going to enjoy that $1 million of equity. Right. Yeah.
Good for the kids. Not. Yeah.
Yeah.
I have. Well, we'll talk. I'll save my question for a minute.
Okay. All right. The other thing you can do is if you're partnering with or using an LLC structure, there's actually what's called the annual gift tax exclusion. And so basically, I as an individual, or any of us as individuals, can give $15,000 to any other individual without ever triggering any kind of tax impacts to either of us. So, Chris, I could give you $15,000, and I could give every single listener on this webinar.
I love that idea.
$15,000. I'm not going to, but but I could. But at any rate, I would never have to pay tax as the person giving the gift, and you would never have to pay tax as the recipient of that gift, so long as it's all under $15,000, right? Well, what we can do is we can actually gift LLC ownership percentages, and as long as we can value the ownership in the LLC at less than $15,000, there's not a tax impact there, right?
So if you gift me 10 shares of your LLC.
Mm-hmm.
And your LLC's worth or whatever, and those 10 shares are less than 15 grand, no taxes for either of us.
Right. And so what I slowly do is I actually, let's say that I have a rental property structure, right? And I slowly begin to gift out, say 5% each year to each of my kids, whatever, and we can value that at less than $15,000. I'm actually moving the properties out of my estate. right? And slowly getting them over to my beneficiaries. And the beneficiaries, as they're receiving it, they actually get more excited about it, right? And so they learn a little bit more about what it means to have rental properties and who do you work with and what's a property manager and, whatever else. But what also is really cool is that you can take advantage of what are called valuation discounts. And so if you're gifting or giving away basically 5% of the company, that's such a minority interest in the company that it's actually not worth, say, maybe what it would be worth if you were gifting away 51% of the company, because you're giving away control if you're giving 51% of the company, right? So what you can actually do is you can value, it's not a straight valuation, because if say 10 shares of your company are worth $17,000, I can discount that because it's not a controlling share of the company, and I can value it at 15,000 even though it's worth 17,000. And so I can actually give a bigger gift without triggering tax impacts. It's kind of a weird concept.
I've never heard that before. And so I'm assuming there's a way too, like if I can, gift out those LLC shares, that I can still, because if someone builds up a rental portfolio business like that, they're going to be most likely a control freak. Which I would put myself in that category. I can gift out some stuff, but still make sure I retain voting control and operational or management operational control.
Right. Yeah. Keep yourself as the individual who can sign checks, who can sign the contracts, whatever else. Keep 51% of the company so you have a controlling interest, but you can give away 49% of that company and not impact your control at all.
Interesting. Okay.
Yeah. And, not only does it achieve some estate planning goals because it begins to remove assets out of your estate, but, if you don't really need all of the cash flow either, you can actually shift money to lower tax rates as well, right?
Yeah.
Yeah. Yeah. So that's potentially a very powerful tool, but like anything else, you are truly giving that away, right? And so you have to be comfortable with giving away some of your ownership interest there, right? So anyways, in all of this, you are not alone. Chris, of course, is a great resource, and I'm sure would love to be considered part of your team. And not to put words in your mouth, Chris, but Business Innovation Group is always here and willing to help in any way that we can. And of course, you can always email info@bigprofitsolutions.com if you have any questions whatsoever, or Chris can get you in contact with me as well.
Yeah, and I'll put all the contact details in the show notes in the episode around this video as well. So, kind of it's a question on estate planning in general, because I'm very fascinated by, when wealth passes from one generation to the other, because it either seems like the generation, that first or second generation that receives the money, they either like squared away people or they're like alcoholic losers. And I kind of, question this myself, thinking big from, hey, I'm gonna hopefully pass on or have the ability to pass on lots of assets. And I'm like, I debate, hey, do I pass along to my heirs? Do I pull Warren Buffett and Bill Gates and give it away? Or what's the in between? Since you do estate planning, have you seen, are there like studies or like, what have you seen out there from like these big wealth transfers to other people? Or maybe you don't want to answer the question because you don't want to, I don't know if there's any issues with clients or whatever.
Oh, no.
But like, I'm very intrigued by the whole, just what happens when people receive the money. Because I first learned this because one of my, who was a friend's wife's, I don't know, mother-in-law or something, one of these like 3 chains down, was the nanny for like the 4th or 5th generation heir of some big old time money, like like DuPont type heirs. And they were, from everything I heard, not, did not have their act together, to put it very politely.
Right.
And I always wonder about that.
Well,
and I'm not really asking you a question. I'm thinking out loud here. I'm just kind of curious on your thoughts or what you've
seen.
I
have some thoughts. I mean, this is a concern. For a lot of people, not because they have, great kids or whatever. And for other people, a huge concern. And I've kind of seen the gamut there. But, what I would recommend, if we're talking about any significant amount of money, is actually looking at a trust. Not so much from a tax planning perspective and not so much from an asset protection perspective, but from a pure estate planning perspective. Because what we can do is there's a lot of ways you can approach it. The first way and the simplest way is to do what they call a contingent trust, where you set out some contingencies and you say, look, if I pass away and any of my kids are under the age of 35 or 40 or 25, whatever age you decide is a good age where people can make good decisions, then create this trust if they're under that age, right? If they're over that age when you pass away, we never have to create the trust. We never have to go through the headache, whatever. But that's a really flexible way to do this. The other way to do it is just have the trust already set up, and it's going to have the terms that it does.
Can you put contingencies in there, like if my kid goes to jail or goes to whatever, like don't give them?
Yeah, I think that you could. I don't know that there's generally with estate planning, we look at public policy. Of course, we look at case law, but we look at public policy. If it's something like, look, if my kid winds up, with a gambling problem, a drug addiction, something like that, there's probably a public policy that would say, yeah, we're going to support the idea that we're going to lock this away. On the other hand, there's a lot of old cases that deal with really nasty, almost like racist issues. That's like if my wife or if my kid is going to, marry a person of a different color, then, we're not going to create this trust. And, that's not to offend anybody on the call or whatever, but at the same time.
No, but that's part of estate planning and real estate. You go read covenants from 100 years ago and they're full of racist stuff.
Right. And so there's public policies against that kind of stuff. And there's public policies against, certain restrictions like that. And so I think it kind of depends on what we're talking about. But, Chris, further to your point, what is the ultimate goal, I think, is where we kind of wind up. Because if the ultimate goal is to give the money to charity, say, what we can do is we can set up a trust to actually benefit your kids during their life, right? And so they can live off of like the income, but then the principal itself, the properties themselves and the equity built up in those properties, maybe that could go to charity, right? Or something like that. And so we can actually split the interests and make sure, and the other thing we can put in there is say, well, look, it's up to the trustee. And if the trustee actually has to sell one of these properties to look after the kids in the way that they're accustomed to and whatever, go ahead and sell the property, right? But when your kids ultimately pass away, okay, then liquidate the portfolio and put
everything goes to charity.
Some good use, and that's a way to kind of like have your cake and eat it too, because everybody's taken care of, but ultimately it goes to some great public cause, right? Yeah.
I think part of it I'm so interested in is like I very much enjoy the challenge of building things. Hey, can I meet these goals? Can I get my net worth up to this amount? Not because I want to drive a Ferrari and have a private jet, just because.
Well, maybe you do.
Well, I don't, but it's just, hey, it's kind of like, it's a game I can play for the rest of my life. I don't play sports much anymore. But I consider just a game. And I want to make sure like my kids, like they have that same, I'm using quotes, enjoyment of the game of like building and conquering. I think it's a big difference. You do it on your own versus, cool, I have my life taken care of.
Right.
But if someone gave me a big chunk of money, I would absolutely take it.
Well, right. Yeah.
So I don't know.
There's that's I think where you give a lot of discretion to the trustee, and you say, you kind of explain and just say, look, I want my kids to go out to make their way in the world, understand what the value of a dollar is, whatever. On the other hand, I don't want them to unnecessarily run their head against the wall, and if they need a little bit of help them, but that's totally up to you, right? It's not up to them, right?
Cool. All right. Yeah. Well, I know we kind of went off on a tangent there. That was more just a me thinking out loud. So thank you, Peter. But no, just kind of wrap up this episode and actually the mini series we did on here. I learned a lot, so thank you. And our whole goal of this is kind of just have an evergreen content or evergreen videos until the next big tax change in 20 years or whatever. That way people can come here and view the resources. So please use them. Come here, view them. Go to that DenverInvestmentRealEstate.com/taxes. I'll hold these 3 episodes. And if we do future one or episodes in the future with updates or different case studies or more advanced stuff, I'll kind of throw them all in that same folder there because I want to use it for myself. I have a lot of clients ask me, hey, what about taxes? And I say, hey, cool, go watch these. Now it's like 4 or 5 hours worth of content. It's phenomenal stuff. So I hope you guys can use them for yourself, with your clients, whatever. If you need help buying real estate, I'd love to chat with you. If you need help with taxes and legal stuff, definitely reach out to Peter. And like I said, all the contact details will be in the show notes. So thank you for watching and listening. And Peter, thank you for taking time out of your busy schedule to come do these with me.
Yeah, absolutely, Chris. My pleasure.